All right, so now we're going to look at a Forex pair, the British pound versus the US dollar. And this is going to be an example of a trendless market where it's not really dependent upon a specific daily bias. And we're just using intraday volatility to find an optimal trade entry. But before I get into it, I want you to take a look at this chart. And I want you to think about what the neophyte or the new trader that's just being exposed to what I teach, or someone that thinks they've been around the block a few times and they think it's just something being renamed, rehashed, reinvented to try to take credit from some old guy that's buried and long since been forgotten. Look at this chart. Now, classically, people will say, well, it's just support and resistance and old highs and old lows where the market's turned before. That's all you need to do. Look for those points. And when I first started, I read the same books these people do too. And I can tell you that if it was just that simple, everyone would be billionaires. Okay? It's not support and resistance that leads to Forex riches. I needed to find out what was really going on. And when I did, all these ideas of support and resistance levels faded away. And I got to the real heart of what turns the market and then why the market should react at specific price levels. So now I want to kind of show you what it is. And it's something that you guys are familiar with if you've been looking at my content for any length of time. But let's go to another chart. Now I'm going to add the perspective that I teach my students. This is the market efficiency paradigm, okay? And what is that? It's basically the narrative of why price goes where it does and why it reacts the way it does once it gets there. And where is it reaching to next? Okay, so this particular candle here cuts to the whole narrative immediately. And the reason why is you want to look at price and look for areas where they run an old high, because old highs right above that is going to be buy stops, and that's what buy side liquidity is. Buy side liquidity could be in the form of buy stops for new entries going long, or it could be buy stops protecting existing shorts. The market rams through that, and this action right here is what I teach as a Judas swing. In other words, it's a fake move. It's to lull people into thinking that the market's going to be bullish, it's going to go up. But generally, when we see these sharp moves that run previous highs, this to me is highly suspect. And if we get back below the lowest down close candle, once it breaks that, which it does here, the narrative changes to bearish. So all I need to do, and my students do, is we go to this candle here, draw it out in time. There's your turning point. That's your real support and resistance level, because it's based on the market efficiency paradigm. That is mine. You're not going to find that in books. You're not going to see any of that anywhere outside of what I teach. And there's a lot of things that go along with this pattern. Too many people go on YouTube now and talk about the ICT breaker, or they just remove the ICT and they call it something else, a banker's candle. You know, everybody's got a new twist on what I'm teaching, and they don't know what they're talking about. What I'm showing you here is the narrative behind finding an optimal trade entry with this structure in place. It's a trendless market environment. It doesn't have to have a bullish or bearish bias on the daily chart. So you go into lower time frames, and this right in here is what we're going to zoom in on. Okay, so we're going to look at the lower time frame 5-minute chart right here. Okay, but before we go into it, since we're on the hourly chart, I want to annotate the previous day's range. Okay, so we have this as the beginning of the 11th and the 12th, which is the day of this recording. And if this is going to be a breaker that's bearish, we're going to be looking at previous day's low. That's where we're going to be targeting. So the liquidity that would rest below that, that's what we're really aiming for. So we're going to drop down to a 5-minute chart in this box here and get a closer look as where the OTE forms. Okay, so here's the 5-minute chart on the British pound versus US dollar on a 5-minute chart for May 12th, 2020. And here's trading up into that area I outlined on the hourly chart where we can see that breaker. Price trades up into it, and this old high, returning to it here, it hits the same level. Again, it's the breaker. It's not the classic support and resistance. It's not the supply zone. It's none of that stuff. Okay, it's the optimal trade entry. Okay, and we'll project this out in time. Okay, so we have the high to the low, returns back to optimal trade entry. 79% retracement level lays right on top of that level here. Your stop will be above here. And the market raids an old low here. And the fib level is here. So you could use 123 big figure as your level, not reaching for the fib because the magic is not the fib, but reaching below this low for the liquidity that resides below here. Now, this is the previous day's range, okay, to the 11th. We also have more time here in our New York session to look for another trade if it forms. Has it taken out previous day's low? Not here. It starts to retrace on this candle here. What time of day is that? 11 o'clock in the morning. That is still time to take another trade, and if it's still there, if it's valid. All right, so we can see the optimal trade entry here. Low and high, retraces back into the New York session. And previous day, or the 11th of May's low, we will be targeting that next. Stop will be above here. Your short will be in here at the 62% retracement level. And again, below the level of the previous day's range, low at, what is that, 122.83 and 1 pipette. And then the next fib level would be 122 and 65 and 5 pipettes. So we will be looking for this as a potential objective, but we can just simply use the 122.70 level. It would be below the 11th low and not demand a full fib. Now you can do that, but in this example, we're sticking to the rules, rounding down and being content. And the result of this is here. Market trades down to the standard deviation of 1 on the range, and we blow below the 11th low. Sweep it here, work on it here, and then expand down. Okay, folks, welcome back. This is part 3 of the continuing series of the ICT Optimal Trade Entry Pattern Recognition series. And we're going to step outside of Forex. As I mentioned, one of the central tenets to this pattern is it's not limited to Forex. So I'm going to show you how you can use it in the futures market. And this is an index futures, and it's the delivery contract of June 2020 of the S&P E-mini futures. All right, so we want to look for a signature in price that would lend well to aiming for a previous day's higher low. And again, it's focusing primarily on a very short-term time frame, but the pattern can be scaled to whatever time frame you really want. So looking at the price action here, you can see that we have a swing low, swing high, and a retracement here. And price was underway going higher, and there's no necessity for you to say, I have to be in this here, or I have to be in this here, or I can't participate in a market like this and be a buyer, which is not true. So I want you to take a look at the framework here. We're presently in a larger daily optimal trade entry. Price just fell short of hitting the 79% retracement level. And again, the magic is not the fib. It's the target of liquidity. That's all I'm doing. The fib just helps me frame an underlying context. It's not that you need these levels. It just gives you a framework, okay? So the framework is we have an old low, old high, retracement, and it starts to move higher. So on a daily chart, where is the likely momentum? It's going higher. Okay, great. It could be reaching to this old high here, or it could fail to run that high, or it could go through it and keep on going higher. In this instance, we don't care. We just know that the likelihood is it's probably going to run a previous day's high. So today's Monday of May 2020, May 11th specifically. So here's Friday, May 8th, 2020. And we're going to denote that high. So that price level is going to be significant when we drop down the lower time frame. Okay, so here is the S&P E-mini futures for June 2020 5-minute chart. And this is a naked chart, so that way you got a chance to take a look at this before I put the lipstick on this particular example. And you can pause the video here. All right, so if you haven't paused the video and studied and looked for what I'm going to cover before I actually show it to you, you're going to miss that opportunity now. The big figure 2900 price trades down into that during the New York session. Whenever a big figure is swept either down into it or up into it, it will generally create some kind of a tradable bounce, okay, or a retracement. And while it may be very short term and short lived, it still gives the opportunity for a quick snap in the marketplace where you can take something out of it. Since this is a futures contract and it's not a foreign exchange pair, we can't talk in terms of pips, so we're going to be using just the range. Now if you look closely, you can see inside of the New York session, the idea is the beginning is here at 8:30 and the end is again 11 o'clock. It's a static time, it doesn't change. So everything that I've shown you thus far, we're just doing the same thing every single day, and you'll see this pattern forms every single day. So let's take a look at the fib over top of this right here. This is the optimal trade entry. The market rallies back above 29 big figure, comes back down into bullish order block, overlapping with the 2900 big figure inside of our specific time of day, the New York session. Okay, 8:30 in the morning to 11 o'clock in the morning, New York local time. This pattern is seen with the fib. So we trade down into the 70.5 level, which is the sweet spot by my definition for optimal trade entry. And you could be a buyer there. And the market comes back down. It does give multiple entries. You can take it on here, which is still inside of the New York session time window that we've created for this pattern. And we have really 3 candles here, here, and here where it meets optimal trade entry, 62 or less down to 79. And you could be a buyer there. We're going to use the range here. Okay, so 0.5. You could take your first scaling there, partials, and look how it spends a little bit of time consolidating there, and then expands up to 1-to-1 full standard deviation here at 29.22. So being a buyer at around 2900 big figure and getting out with 15 handles in the S&P as a first scalp or scaling, then your secondary exit for a partial could be at 29.22, which is 22 handles in the S&P. Then ultimately, as I mentioned in this pattern, this level here on the fib, if it gets to that price level and runs a specific price point for liquidity, which is the Friday's high, which is we annotated on the daily chart, the market will likely rather want to gravitate towards that old Friday high because the trend is bullish. It's going to want to take liquidity out of there because a lot of people are short selling in the S&P. The market has taken up above Friday's high and to the fib level 29.36. The high comes in on this candle at 29.37, only off by 1 handle on the S&P, and it went up again to another opportunity to do so, and again 29.37. So it's only off by 1 handle, but you could take this idea here and instead of reaching for the 29.36, round down to the nearest 5 level. So that would be 29.35. So that's 35 handles with as much as 1, 2, and 3 partials taken out. But at this point here, I would be out for this particular pattern in this market as an example. Okay, so here's what we're going to do. We're going to take a look at the annotations for today. Here is the previous day's range. And the previous day's range is defined from here to here. So we're expecting a run above the previous day's high. So here's previous day's high at that 106.657 level. And we're looking for a reason to get long to target this high. And we can see from the previous day's range, we have this low up to this high. And then all the way over to our New York session time from 8:30 a.m. New York time to 11 a.m. New York time. You see the vertical lines as I outlined yesterday. We'll take these off to keep things clean. You can see how price drops down into it here. And we're going to assume that 106,314 is that 62% retracement level. So we're going to just round it to the nearest 5 pip bet. So 106.315 would be our entry. Below the low, our stop will be at 106.215. So it's a 10 pip stop. Optimal trade entry. Old high that makes the range of the fib comes in at 15 pips. So it meets our minimum criteria for the first scaling. So you could take profits there. Second scaling for around 25 pips here. And we're still below previous day's high. The next level at the fib, which is a 10 level, is nice because it's above the previous day's high and it's a 10 level. So we can take a third scaling out there for around approximately 40 pips. Additionally, you can see this swing here from this low to this high being 1, 2, 3 for another optimal trade entry, because you can see the low comes in just at 10:55. So it's 5 minutes before the end of our New York session for limited of time. And you can see we run this old high here. So from here to here, that's another opportunity you can study on your own and annotate your chart. And you can see where we closed for the day.